Good morning, everyone, and welcome to TBR's webcast, Disruptive Technologies, How Analytics, Digital, and Cloud Are Coupling Technology to Strategy Consulting, which outlines performance, leaders and laggards, and future trends as reported in our Management Consulting Benchmark. I'm Allison Crawford, and I'll be your host for today's webinar. The management consulting industry experienced significant consolidations and change over the last 6 months. The biggest management consulting vendors continue to grow in the first half of 2013, but previous acquisitions helped smaller firms grow faster. Surprisingly, technology-centric firms fared the worst, even as trends favored their expertise and deep technology experience. Technology Business Research's 5th iteration of the Management Consulting Benchmark analyzes these changes, and over the course of the next 45 minutes, we'll highlight high-level findings of this unique research, including how disruptive technologies affect the market, the imperative to train and or gain the right skills, and shifts in the management consulting landscape. This research is available for purchase now. Before I pass this over to Patrick and the rest of the Management Consulting Research team, there are a few logistics I'd like to cover. First, we're recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. We'll address them at the end of the presentation. Or you can request an inquiry call if you have additional questions. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides, as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight. And I'll share all the social media links again at the end of the presentation. Now let me introduce Patrick Heffernan, Jen Hamill, and Harry Norton. Patrick is a State Department and Deloitte alumni and is the lead on our Management Consulting Benchmark. Jen and Harry are research analysts focusing on the vendors imported in the benchmark. And with that, let me hand the presentation over to Patrick.
Great, thank you, Allison. So management consulting seems incredibly simple. You have MBAs sitting around talking about strategy and supply chain. You have technology architects who are setting up your new IT system and designing it. But of course, it's a lot more complex than that because the vendors have different business models, and when the landscape is constantly changing, it's forcing those vendors to change not only their strategies, but their business models as well. So in order to understand where these management consulting vendors are today, we're going to go back a year and look and see what things look like in February of 2013. And then we're going to look at 3 particular companies and the strategies that they chose to implement over 2013 and how that positions them going forward. So by the end of this presentation, you should have a good sense of what strategies maybe mirror your own company and your own company's approach. You'll have an understanding of what worked well for these companies and what some others are doing. And so if 2013 was a year for strategic readjustment and maybe fine-tuning, then 2014 is going to be the year where we see whether or not those strategies paid off. They're going to be put to the test, really. So again, at the end of today, you'll have a sense, okay, what are the measures or what are the signposts that you should be looking for to indicate who's doing well and who's doing not. So just to set a baseline understanding of TBR and our research that goes into this presentation, we do analysis based on financial modeling, based on discussions with both management consulting vendors and their clients, and we do a lot of secondary research, of course, and all of that gets fed into a benchmark. And you can read here what the details are behind that analysis. And we've done this for a few years now. Allison mentioned this is the 5th iteration, so we have a very solid baseline that we're starting with when we look at these companies. So if we're going to talk about 3 major themes here. The stronger getting stronger, alliance and acquisitions were used as growth strategies, and then reorganization as a reaction to what is happening in the market. But as much as possible, we're going to try to frame that around business models and around the 3 companies that we're using as an example. So if we take a look at where we were at the start of 2013, you can see there our predictions at the end of 2012 and whether or not we were right. And of course we were. All right, we were a little off on manufacturing, but otherwise we got it pretty much right. And that's nice, but what's important is what's on the left. You see the strategy-centric vendors. So we're talking about McKinsey, Bain, Booz, BCG. Those firms were all getting deeper into technology consulting. This is, again, the beginning of 2013. The solutions-led firms, that means Accenture and IBM primarily, they were leveraging their own technology experience, just like Allison mentioned, to move up in the management consulting space. And then the Big Four, of course, had a seat at every table, and they were the ones that had the largest share of the management consulting pie, but they also had the largest set of solutions and the largest set of offerings. So throughout all this, of course, as you see it, the title is Emerging Technologies, which permeated everything. And emerging technologies really in 2013 sort of changed from just being a bunch of buzzwords, digital, big data, analytics, mobility, into actual offerings and actual solutions that companies are doing well rolling out. So as we get into what the space looks like, we're going to get rooted in the actual data that's behind all this. So if you look at these pinwheels, we're really proud of these, and if there's any feedback you want to provide on this webinar, absolutely please let us know what you think of these graphs. We love them. Not that I'm biased towards that or anything, but what it shows is the center circle is the revenue for 2011. The middle circle is the revenue for 2012, and then the outer circle is the estimated revenue for 2013. And it shows a percentage share of the benchmark revenue. So that is not the market as a whole, that's the revenue of these 16 vendors in this management consulting space. And why we grab these two are because Deloitte, of course, is the largest, and McKinsey is the third largest, but you can see if you track Deloitte up through that pinwheel, as the percentage of revenues that are gained by the Big Four grow, Deloitte's percentage of overall revenues in the overall pie grow as well. McKinsey is the opposite. So the strategy firms have been growing in their percentage of revenues, but McKinsey itself has been, while its revenues are still growing, its percentage of the benchmark's revenues have been going down. Now, there could be a lot of different reasons for that. We're going to go into some in a little bit, particularly on McKinsey. One thing to note, McKinsey's strategy consulting revenues are actually higher than Deloitte's. Now, the benchmark breaks it down to strategy, organization, operations, and what's technology, of course. That's the fourth. So McKinsey's strategy revenues are actually higher than Deloitte's, but they've not been growing as fast, and it's pretty clear Deloitte's going to overtake them. Most interesting, of course, is that E&Y, which we don't have up here singled out, was the fastest growing from the first half of 2012 to the first half of 2013. So they're a company to keep an eye on, and in a little bit, Jen's going to talk about some of the acquisitions they made. So then, just to give you another look at what else is in the benchmark itself, here are two just simple pie graphs that show that we cover the verticals and we cover the geographies as well. I grabbed Accenture's share of energy because I think it shows you how far along or how far ahead Accenture actually is than the rest of the pack, and energy is a critical vertical going forward because, of course, analytics, digital mobility are all going to grow significantly within that vertical. So Accenture has positioned itself well there. We're going to go much deeper on Accenture in a little bit. And then I took BCG out of the APAC revenues just to show you that's sort of a common slice of revenue out of APAC, but what's really important is what's at the bottom of that chart. And you can see that the Big Four have 52.6% of all the revenues that are derived out of APAC. And if you look to the left, they have 40. So basically, through every single metric within this benchmark, to reinforce that idea that the big keep getting bigger, and the Big Four are there. They have between 40 and 55% of pretty much everything and all these revenues, no matter how you break them down. So that gives us a grounding in the data and the metrics that are used. So what we're going to do now is we're going to look at strategies and what was done in 2013. So again, 3 companies, 3 different approaches to change in the management consulting space. We're going to highlight one that made the most significant acquisition, but before we do that, we're going to have Jen sort of set the table for the entire acquisition space.
Thanks, Patrick, and hello, everyone. I just want to give an overview of the acquisition activity that we saw in 2013 in the management consulting space. As businesses begin to adopt emerging technologies, not only to improve their IT operations, but to transform their business models, we're seeing firms investing in acquisitions and alliances to shore their digital technology portfolios and expertise. And you can see in this chart here that the acquisitions cut across all service lines, from technology to strategy, operations and organization. And this is what we see as reflecting the convergence of these service lines to help customers meet their business outcomes. And we're also seeing that acquisitions are being used to deepen capabilities in industry expertise and geographical expansion. And this is a key tool that management consulting firms are using to differentiate themselves from competitors. So just to give a couple of examples, Patrick mentioned EY, and you can see that the big four vendors are represented throughout this chart. They're definitely the most active in the acquisition space in 2013. But just for one example, EY purchased Greenwich Consulting. This is an acquisition that took place in the second half of 2013. And Greenwich Consulting adds 130 employees, most of which are based in France. And they'll add to EY Advisory's worldwide headcount of 30,000. And the acquisition also enhances EY's growth strategy consulting. The most important that we are seeing with this acquisition is adding to their digital transformation capabilities, as well as marketing strategy and data analytics. And the second group of acquisitions that I wanted to point out here are the smaller firms, the HR and HR and specialty consulting firms. And obviously, they compete in a very small area of management consulting. So instead of trying to put together end-to-end capabilities that some of the larger Big Four firms are doing, they're trying to specialize more deeply in niche areas. So a couple of examples, Mercer bought Hull Consulting, and they provide salary benchmarking unique to the North American energy industry. And Aon bought Dempsey Partners, which provides specialized risk management consulting for the financial services industry. So each of these examples highlights the vendor's investments to add niche consulting expertise as well as emerging technology capabilities. And this is all serving, the transformational needs of clients as they move toward digital technologies. And so the biggest acquisition I think that we want to highlight here is PwC's acquisition of Booz & Company. And TBR published a few pieces toward the end of last year about this acquisition and how it impacts both companies as well as the management consulting landscape as a whole. But in summary, the Booz & Company acquisition adds 4,000 employees as well as $1.5 billion in annual revenue. Another important thing to note is that Booz & Company has delivered consistent double-digit growth over the past 3 years. But as you can see by this continual graph, that it still doesn't bring PwC up to the level as far as revenue as Deloitte or EY. And we've listed a few of the areas that this acquisition benefits PwC, but just to highlight a couple, we believe that the driving factor behind the acquisition is giving PwC access to Booz's global talent prestige. Booz is widely recognized as a top-tier consultancy, which allows the firm to recruit top MBA and undergraduate talent. And as well, Booz is also active as a thought leader in a variety of growth industries, including retail and energy, which we expect will support PwC's expansion in key verticals. The second area that Patrick will go into more detail a little bit later in the slide is Booz Digital. And what we're seeing, the biggest benefit for PwC with this acquisition is Booz & Company has been quite active in investing in digital transformation, and so PwC will be getting the benefit of that by acquiring Booz & Company rather than having to develop these capabilities on their own.
One thing I would add on this, and we spent a lot of time talking with folks at PwC and at Booz and actually all around the management consulting space once this acquisition was announced, and what seemed to resonate the most was that what PwC really bought was people and permission. They bought the people that have the strategy talent that they, well, I hate to say PwC didn't have, because I know that they have a strong strategy practice already, but it certainly added some cachet. It certainly added, like Jen said, some prestige. So they added people, but they also got permission, because Booz was certainly one of those firms that was always in the discussion when it came to strategy, when it came to sitting in with the CEO now. And I could see a question came in about Booz Digital being part of BCG. Actually, the head, or one of the guys who started Booz Digital, went over to BCG, but the actual, the sort of assets and the IP and all that was part of the Booz acquisition by PwC. So yes, the guy who started it is at BCG, and one could argue that that is a key person. And if we're going to talk about people, you certainly lost a little prestige there. However, I'm sure PwC knew what they were getting when they bought Booz and Booz Digital along with it. It's the people and permission part that I think are critical to understanding that acquisition. That, and of course, it significantly shook up the management consulting space. So with that, we're going to turn now to Harry to talk about the other firm that's been shaking up the space quite a bit through alliances and acquisitions. Harry?
Hi, yes, thank you, Patrick. I'm going to take you through McKinsey & Company, or the firm. What I have up here is a display of a timeline from the formation of McKinsey, which was founded by James O. McKinsey in 1926, all the way through to the most recent alliance with Lufthansa, which created Lumix. I'll go into detail about that in a minute. They're European-based. Now, McKinsey has a well-established European base, as it founded its first office in London in 1959. Now, during that time, American vendors, American firms, especially McKinsey, just took over the European market because of their initiatives of cost-cutting. Now, that allowed them to expand and take over Europe, if you will. So I'm going to go into Lumix a little bit. The formation of Lumix we believe, is going to be focused on the aviation industry, because McKinsey's Lufthansa has an aviation technical services service line, and they will be working in the aviation market, as I just said. We believe they will be focusing on the Nordics as well as the Middle East. Now, we've seen a lot of growth in the aviation industry. Our public sector companies, for instance, L3 Communications, has their Spider, which is a manned drone, and whereas Northrop Grumman has the Global Hawk, which is an unmanned drone. And both companies are experiencing major backlogs, and driven in part by Boeing and Airbus. On another note, General Dynamics has Gulfstream aimed at the commercial industry, and they are seeing a surge in revenue as well, for personalized jets, if you will. After that, I want to explain that this is an example of McKinsey being a thought leader. Now, in the past, they've turned a blind eye to certain trends, such as BCG, when they founded the quadrants in the 1970s. They ignored the entire movement and tried to disregard it, but what happened was, BCG continued to grow using their business matrix. Another example is they took their time with the coupling of technology and services, and eventually created McKinsey Solutions in 2009. Now, in terms of identifying emerging markets, McKinsey's alliance with Lufthansa is very similar to its alliance with Nielsen to create NM Insight in 2010. Since then, NM Insight is focused on the social media movement, which right now is surging. And in fact, we're going to be talking about that with Accenture, and another, with their movement in digital marketing, digital movement, as well as, we just talked about PwC and Booz. IBM and Capgemini, on a side note, have also established digital service lines to capture this opportunity. It's specifically within retail is the biggest opportunity for target marketing. Understanding a customer's preference with regard to their purchasing behaviors to try to create a custom marketing campaign, if you will. on a side note, McKinsey has disproved the effectiveness of the social media aspect in regards to Twitter and Facebook, and has found that the traditional email is more effective. So what I believe and what we believe is that NM Insight will be catering its marketing movement to emails for specific needs and wants of customers. Now, despite being committed to its one-firm approach, which was started by Marvin Bauer, McKinsey has recently announced a strategy which involves increasing its M&A activity, which we believe will be technology-based, like Henry Rack and Finalta. Both acquisitions became a part of McKinsey Solutions, and we believe that that's what they will be catering to gather a better market share in comparison to the Big Four. We also believe that they will continue to seek out alliances, not only in the joint venture aspect with Lumix and NM Insight, but on just a partnership aspect like ClickBox, which ended up becoming a part of McKinsey Solutions as well as its own standalone offering. Now, that's my summary of McKinsey, and I will hand it back to Patrick.
Excellent. And I think, the real important thing to note there about McKinsey is just how the firm itself has not changed much. I mean, that's what Harry's timeline sort of showed you, but more importantly, the firm hasn't changed, the landscape all around it has. And McKinsey, I'm going to talk about this at the very end, but is absolutely at the front end of understanding where the market's going and being able to adjust to that and make the right moves. I'll sum up McKinsey again in a little bit. So now we're going to go on to reorganization. And here we're looking at Accenture now. So if you, again, throw yourself back to the beginning of 2013, rumor was actually that that Accenture was actually going to acquire Booz. Maybe that was going to happen, maybe not. But by the end of 2013, as we hit December, is when Accenture rolled out Accenture Strategy. And the idea is bringing together the strategy consultants and the technology consultants sort of into the same room, make sure that they go to clients together, make sure that the solutions, the offerings, everything is all centered around both strategy and technology at one time, which when you look at the marketplace, again, go back to the beginning of this presentation, emerging technologies permeating through all of management consulting, it only makes sense to have both your strategy expert and your technology expert together in the same room working with the client. So Accenture Strategy pulls all that together, and to put it in a little bit more context, of course, consulting and service systems implementation or integration is a huge part of Accenture's revenues. 50-something percent, I want to say like 52% of Accenture's revenues. It declined slightly in 2013. We expect it's going to be single digits going ahead into 2014. So you can see why they would want to make sure that their strategy practice, that their reorganization goes after that CNSI component right there. The other thing is that PwC and Deloitte, well, PwC's acquisition of Booz obviously had a factor in Accenture's decision. Deloitte acquired Monitor a while ago. Both of those companies, Deloitte and PwC, have been growing in their strategy consulting practices over the last couple of years, while Accenture has remained flat. So as a company, they needed to do something to go after that revenue, go after that area for management consulting, and a reorganization made sense. Then the next thing that sort of dovetails nicely into that is digital, where Accenture rolled out, again, at the end of 2013, the Accenture Digital Platform, and that pulls together, you can see it right there, interactive mobility and analytics. It's based on a bunch of acquisitions that they did, and it mirrors beautifully what Booz Digital was doing on the left side of that screen, and follows in with what everybody else was doing, making these acquisitions in the digital space. It's hard to say how much, it's hard to emphasize how much this makes a ton of sense. Accenture couldn't make that blockbuster acquisition of Booz. They had been losing market share, or at least been growing slower than their competitors that they model themselves after most, Deloitte and McKinsey, to name the top two. They had to do something. Pulling together Accenture Digital Platform allows them to talk to the market about emerging technologies in one way, with one voice, which, again, when you think about all the buzzwords out there around big data, analytics, social, mobile, digital, and all that, to be able to pull it all together and say, look, this is our solution, this is how we roll this out, this is how we deal with all of your questions and the possibilities around this, just makes a ton of sense. And then when you put the two side by side, Accenture Strategy and Accenture Digital, it's a reorganization that overall just makes a ton of sense. So wrapping it all up, you can see here, this is the things that we're looking at for the second half of 2013. Now that may strike you as a little odd since we're already into 2014, but the way the benchmark is built is that we look at performance from the half year previous. So we're doing the research now, gathering all the secondary and the primary data that will feed into the metrics for these companies' performance in the second half of 2013. But as you hear from this webinar, we're already well into our thinking about what is happening in 2014 and how we're going to measure that. So to sum it up, we looked at acquisitions as one strategy, we looked at alliances as another, we looked at reorganization. In acquisitions, I don't think we're going to see a blockbuster acquisition in 2014, nothing along the lines of PwC buying Booz. The other strategy houses are not the same size. It wouldn't be the same fit for them to go into one of the big four, to somebody else, maybe to IBM. We just don't see that happening. On the other hand, I think we're going to see a lot of the smaller acquisitions that were made in 2013 and going back to 2012 really start to pay off. So the acquisitions that Jen detailed, I think we'll start to see the revenues coming directly from them very soon in this year. The other thing, alliances. Everybody does alliances. You can look at that and say, well, that's not a particularly special strategy. McKinsey and Lufthansa is a special kind of alliance, and that's because it follows on with McKinsey and Nielsen Media, and it shows that the firm is thinking about how they're going to approach the problem of emerging technologies within the strategy and the operations consulting space. And rather than try to compete with Deloitte and Accenture on technology, they're going to form these special kinds of alliances that allow them to bring to the table the technology experts. But, and here's the key part, and what makes it really different is they're doing it in a very specific vertical. So NM Insight was looking at media and retail, and the Harry, help me out. It's called Lumix. Is that the
Lumix is the joint venture.
Right. That one's looking specifically at the aerospace industry, and as Harry explained, that's an industry that's really set to grow in the next few years, and so McKinsey is right at the edge of that, the leading edge of that. And then the last thing, as I mentioned with Accenture, that reorganization, it only makes sense. If you throw yourself back even further, 3 or 4 years ago, and consider the way that a lot of the management consulting firms were organized and went to market. And then you appreciate how much strategy consulting and emerging technologies have come together. You'll see that it only makes sense that you have to reorganize in order to actually go after this market in a way that makes sense. So hopefully that all made a lot of sense, and it's valuable to you to understand how the business models are changing, how the environment that's out there is forcing these firms to do something different, and that's where we see things going forward. And I welcome questions, and I welcome ideas on areas that we haven't covered and that we should be thinking about over the next 6 months.
Great, thanks, Patrick. And thanks for those of you who've sent your questions through now. We have a couple in queue already. So if you have a question, send them through to me, and I will have the panel here answer them. So the first question we have, guys, is what other vendors not included in the benchmark pose potential challenges to the management consulting landscape?
So the 16 vendors that are in the benchmark are sort of the traditional management consulting vendors. They're the ones that have draw the largest revenue, particularly from strategy and operations. But they're looming on the horizon, of course, are the firms that have been in IT and have been in consulting for a long time and who are trying to make their way up, I would say, the consulting ladder. But I'll turn it over to Jen for her thoughts on that.
Yes, I definitely agree with that, Patrick. We're seeing a lot, particularly with the India-centric vendors, who have traditionally been more focused on the low-cost outsourcing side of IT, as those contracts are becoming, smaller, the services are becoming more commoditized. We're seeing India-centric vendors moving into consulting to try to, number one, form closer relationships with clients that will lead to longer-term engagements, and also just to, be able to access higher levels of the organization, including the C-suite, to, form more of an end-to-end engagement that not only transforms the client's IT services, but also, how they run their business toward more change-to-business type contracts. We're seeing India-centric vendors making investments in consulting, particularly in Europe. TCS, Infosys, and Cognizant each made an acquisition in the past year in Europe that enhanced their vertical-specific capabilities with consulting.
One of our clients asked us specifically about one of their direct competitors in their space. And one of the things that we considered is whether or not that competitor would get married to an India firm so that competitor could provide that kind of end-to-end thing that Jen was just, or the kind of end-to-end offerings, solutions, the whole package that Jen was just talking about. And of course, where it gets tricky is that what does a marriage like that exactly look like, and what are the prenuptials, I guess, you got to sign. We haven't worked that out, but I think that would be a fascinating change to this particular market if the Indian-centric firms were able to barge their way in. It ties back, though, to people and permission. PwC acquiring Booz brought them that in the strategy space. I would think that a Wipro or an Infosys would need to do something that wholesale in order to move up rapidly into the strategy and the operations space the way they would want to. So hopefully that answers the question.
Okay. The next question in queue. Actually, this is someone who was on the webinar 6 months ago and remembered that you talked a lot about IBM. They said this time you barely mentioned them. What happened?
Yeah, what happened to IBM? Well, they got hammered in China on hardware, but that doesn't really explain what happened to them in management consulting. They have, for a couple of years now, been struggling in this space, not because they don't make plenty of revenue, but they just haven't been growing. And when you look at, again, to keep in mind, we kept throwing ourselves back to 2013 and the start of that year, of last year. IBM made no significant moves. They made acquisitions. There wasn't that same kind of reorg in 2013. Now, they've started to roll new stuff out with Watson. They've started to, they've shed part of their hardware business. They really aren't a hardware company anymore at all. But they haven't made those kinds of moves in the management consulting space that we think are going to change what they bring to the table, or more importantly, what kind of revenues they draw and the growth that they have in this space. So the story of IBM in 2013 is a company that didn't do anything really exciting, and when you compare them to Accenture, PwC, and McKinsey, they were kind of off our radar in a funny kind of way.
Okay. We have one more question, so if there's any additional questions, please send them through now. You mentioned McKinsey's acquisition, and there was a Booz acquisition on one of the slides. Have the other strategy companies, Bain and BCG, made acquisitions too? If not, why not?
So the book on the strategy houses, Bain, Booz, BCG, and McKinsey, is that they don't make acquisitions, that they only grow organically. And a reason for that is that they are selective in their hiring and very selective in who stays with those firms. And so that over time they've built a culture and they've built a certain kind of professional within their ranks, and that any kind of acquisition would require altering that culture and or those professional tracks. That said, of course, Booz made acquisitions in 2013 instead of McKinsey. So they are either at the front end of what's happening with those firms changing, or they're the standouts. And so the question is, will we see BCG and Bain make acquisitions in 2014? I'm guessing they won't. I'm guessing they're going to do the kinds of things they've done before. And actually, the BCG hiring the guy who started Booz Digital is a perfect example of what a company like Bain and BCG are likely to do. They're likely to go after people. They're unlikely to go after, I don't want to say institutions, but likely to go after competitors or other companies to make those acquisitions. Harry, do you have any other thoughts on that?
No, I mean, generally I wouldn't think McKinsey would be going for an acquisition, but the reality is that if you want to get into a field very quickly and if you can't acquire the talent right away, you go ahead and go out and buy a company like Henry Rack or Vanessa.
Yeah.
So those two come to mind. But yeah, as for BCG and Bain, you know, there's, like you said, acquiring the front-end talent, those companies are the top of mind for people graduating from Harvard and Yale and the other Ivy League schools. So they're going to attract some high-end talent, and that's what I think will happen. So.
And that makes sense. Makes sense.
Okay, we have another question in queue. You mentioned that the consulting system integration capabilities will be key for vendors. Is this really a new requirement for vendors to grow?
That's a great question, because the strategy, operations, organization, and technology taxonomies that we use for this management consulting benchmark do not include systems integration. And in fact, we've had lots of discussions with clients that buy this about how they account for their own CNSI practices within our benchmark and where we draw the lines. All of that is a way of saying that systems integration is going to get tricky. And when we're talking about this particular benchmark in management consulting in particular, it's not a requirement for these vendors to grow in the management consulting space. I think it is a huge requirement for these competitors to continue growing if they want to be the end-to-end solutions provider. So, probably the biggest example I can think of is that Deloitte's outsourcing practice or outsourcing revenue was close to $1 billion in 2013. It's going to top $1 billion in 2014. So there's an outsourcing part of this that's not in the management consulting benchmark at all. But Deloitte, who leads management consulting in terms of revenue, has already figured out that they need that kind of practice in order to fill out the entire portfolio of solutions and offerings. So the question then becomes, well, would Towers Watson, would McKinsey, would Bain, even would KPMG consider systems integration as essential to their growth? It depends on what they want to go after. If they really do want to have that end-to-end solution and compete with the Indian vendors, and that's not easy because they're extremely good at what they do, and those margins are not large. And the headcount that's necessary at the moment to do it is quite large. So I guess to come all the way around to answer the question directly, no, it's not. Unless that is what you want to be. Unless you want to be a management consulting all the way through systems integration kind of firm, in which case you're going to be up against those guys anyway. You might as well build that capacity. Hopefully that answers the question.
Okay. Hold on. So we had another question that's come through, guys. How do these tech-related acquisitions impact the culture at firms like McKinsey that traditionally viewed the technology consulting space with disdain? Effectively, this is about firms trying to be all things to everyone instead of sticking to their niche. How do they deal with this from a cultural standpoint, and also, do these moves start to dilute their brand in the client's mind?
Harry, do you want to talk about that first, or do you want me to go?
Yeah, I'd like to take a stab at that. The reality is that McKinsey has made the acquisitions that they have made, but if you notice, they're as standalone solutions. They're not exactly putting their name behind it, if you will. It's not McKinsey. It's like McKinsey's Henry Rack, McKinsey's Finalta. You know, the reality is that they are willing to provide you with these technologies solutions, but they're not saying, hey, you're getting McKinsey's actual, you know, you're not getting a McKinsey elite person to actually implement it, but you're getting them to consult with you while the other people are providing the technology. An example, you know, NM Insight and Lumix, perfect examples. They're the partnership, the other end of the partnership is doing the implementation, the technical services, all that stuff, using their solutions, while McKinsey's got their name behind it, but they're doing the consulting side. They're not getting their hands dirty, if you will. They're just simply using the name. They're trying to provide the end-to-end solution without ruining their image, their culture, the one firm approach. They're trying to keep the one firm approach as is, so they're not diluting the brand.
Here's where it's going to get tricky. The business model is going to take an impact on this. It has to. It has to change. So McKinsey, at some point, is going to have to account for professionals who are employed by McKinsey who are doing work that is not what is typically thought of as McKinsey kind of work, that is sitting around with the CEO talking about strategy. So how do you reward those people? How do you retain those people? How do you reward them? How do you create a career path for somebody who is not going to be sitting in with the CEO talking about strategy? And there are different ways to do it. Booz Allen Hamilton and Deloitte in particular, quite a few years ago, rolled out these specialist master career paths where they had people who were not on a partnership track, but who had an expertise that the firms wanted to keep in-house and reward. And so those folks were given a path towards their own professional development that was different than a traditional partner. So that's a model for McKinsey to follow. Whether they will or not, I don't know. But it will have an impact on how they do business, and it'll have an impact on revenue per partner. It'll have an impact on all that stuff. Is it diluting brand? That's a great question, and it's something that we talk to clients about. Why do you buy why do you buy from a particular firm? And brand is a huge part of it. So I think what Harry was saying about the ability to keep the McKinsey name at least one handshake away from the technology consulting part of it, I think will remain important. Okay, we have another question?
We have another question that came through. Regarding partnerships such as McKinsey and Lufthansa, what will be the nature of the relationship? Subcontractor, joint venture, revenue sharing, etc.?
That is particularly, that particular example is a joint venture. McKinsey is providing, again the consulting aspect, the talking with the CEO, explaining the whole strategy from top to bottom. They're also going to learn the brand, though. They're going to learn the vertical, because that's what McKinsey does. They become experts at the vertical. They sit at your table and they don't leave, if you will. They become a part of your company. So, that being said, I feel like they're going to learn Lufthansa's. They're going to take all the knowledge Lufthansa has generated over time in the aerospace market, and they'll eventually become they are experts, and they will show that they are experts in the field through that joint venture. And now they're going to also say, hey, we've got this is how you need to do it, and this is the technology that you can use. That's not only limited to the aerospace industry, as a matter of fact. I forgot to bring this in. Lumix also sees opportunities in energy, chemicals, automotive, as well as the pharma industry. So, although initially in the aerospace market, it can expand into much, much more. And this comes into McKinsey. They have a presence in just about every one of those verticals, if not all of them. So that's how I feel that will come about.
I would just add that I would be shocked, and not like shocked, but actually shocked, if McKinsey rolled out a joint venture like this anytime soon. Another one, I should say. I don't think we're going to see a lot of these. I think McKinsey moves at a certain deliberate pace. NM Insight was in 2010. This thing with Lufthansa was in 2013. So I'm not saying it won't be till 2016, but I don't think it's going to happen right away. What's important for us to know is that within the management consulting space, who is going to follow McKinsey in doing these kinds of joint ventures? Who is going to use their brand and stick along with a brand like Lufthansa and try and go after a vertical in the same way? That's what I think we're looking for in 2014. When I mentioned at the beginning of the presentation, what are the measures and the signposts for how these strategies are playing out. For McKinsey, it's not whether or not they roll out another one, but it is for the others whether or not they do something that imitates McKinsey's approach. Again, I hope that answers the question.
All right, looks like there aren't any other questions in queue, so with that, I'm going to start wrapping things up. So I want to thank everyone for your time today, and thanks to the analysts for the presentation. Wanted to highlight that this is a high-level view of the management consulting benchmark, and I realize that there's lots of folks on the line that may have questions that aren't comfortable asking questions in front of other folks. So if you would like to have an in-person conversation, a private conversation, please do reach out to us, and we can set that up. As I mentioned, I was going to share all the social media links with you. So you can follow all the analysts here on Twitter as well as TBR, as well as join the conversation on SlideShare and YouTube. So if you found this presentation valuable, like to send along to other colleagues, please do so. Or if you'd like to set up in the conversation, as we said, you can reach out and do that as well. We have a couple more questions that did come through. We'll follow up with you guys privately since we are about to close the presentation. So just hang on the line and I'll respond to you in email. Just give me a second. As you are leaving the webinar, there is a short survey, 3 questions. How valuable was the presentation? How good were the presenters? And if there's any other feedback you'd like to give us in terms of certain approaches to research you'd like us to take, areas for discussion, what have you, we are taking that feedback very seriously and using it to change our presentations and the way we engage with you guys quarter to quarter. So we would like to see any feedback that you have. I'm going to leave the chat function open another minute or so in case there's any last-minute questions or comments. And if we don't hear from you now, please do join us on the social media, and we will give this presentation again in the next 6 months. We'll update you on what's happening, and we'll let you know if IBM does anything between now and then as well, right? What a difference a year makes. So thanks, everyone, for your time, and have a great afternoon.